Most people think gold is rising because investors are scared. That's not true. Fear comes and goes. What's happening right now is something much colder, quieter, and far more important. The institutions that designed the global monetary system are quietly preparing for its next version, and gold and silver are sitting right at the center of that transition. This isn't about hype, it's about positioning before the rules fully change. Who I am and what this video is about. I'm Ark. For nearly a decade, I've spent an unhealthy amount of time studying central bank balance sheets, reserve flows, and the signals that never show up on price charts. If you care less about daily price moves and more about why the system itself is shifting, subscribe because that's what this channel exists for. By the end of this video, you'll understand why central banks are absorbing physical gold at record levels, why the dollar isn't collapsing but is losing leverage, how Basel III quietly reshaped demand for physical metal, and why this matters even if you never trade commodities. The price move is the effect, not the cause. Yes, gold recently surged above $5,200 an ounce. Yes, silver pushed past $116. Those moves feel dramatic, but they're not being driven by retail frenzy. Western coin and bar demand is flat. Futures positioning isn't euphoric. So where is the pressure coming from? From buyers who don't care about short-term price at all. Central banks. From 2022 onward, central banks have been buying over 1,000 tons of gold every single year. To understand how large that is, consider this. Global mine production approximates 3,000 tons annually. Jewelry and industry absorb most of it. Central banks are quietly removing what's left. That's not speculation. That's balance sheet restructuring. This happened before, and it wasn't random. The last time central banks accumulated gold this aggressively was the late 1960s. Back then, the dollar was as good as gold, at least on paper, but the math didn't work. Too many dollars, not enough gold. So, central banks did the only rational thing. They converted paper claims to physical metal. By 1971, the gold window closed. By 1980, gold had repriced nearly 20x higher. Not because investors were excited, but because the system demanded a reset. The dollar isn't dying, it's losing exclusivity. This is where people get confused. The dollar is not going to zero, but it is losing its monopoly. In 2008, roughly 65% of global reserves were held in dollars. Today, that figure is closer to the high 50s. That shift represents trillions being redirected. Where does it go? Some into other currencies, some into alternative trade arrangements, and a meaningful portion into gold. More importantly, countries increasingly want their gold inside their own borders, because in a world of sanctions and frozen reserves, control matters more than yield. Trade is quietly bypassing the dollar. Energy and trade settlement used to be simple. Oil priced in dollars, dollars recycled into US debt, deficits funded effortlessly. That structure is evolving. Bilateral trade is increasingly settled. Yuan, rupees, local currency swaps, regional payment rails that bypass SWIFT entirely. Each step reduces structural dollar demand, and when reserve demand weakens, hard assets strengthen by comparison. Basel III. What actually changed? You've probably heard dramatic headlines about Basel III and gold. Here's the truth without the hype. Gold has been Tier 1 capital for decades. That part isn't new. What did change is how banks are forced to treat physical versus paper gold. Allocated physical gold, low risk, balance sheet friendly. Unallocated paper claims, high risk, capital intensive. As capital requirements rose, banks had a clear incentive: own the metal, not the promise of metal. That creates slow, structural demand that doesn't disappear with market volatility. Supply can't stretch, especially for silver. Gold supply grows slowly by design. Silver is even tighter. Silver isn't just monetary, it's industrial. For solar, EVs, electronics, medical tech, data centers, and unlike gold, most silver production is a byproduct of other mining. That means higher prices don't instantly create new supply. Add rising physical demand and shrinking inventories, and you get stress, not speculation. When paper markets promise more metal than exists, reality eventually intervenes. This isn't a trade, it's insurance. Here's the key takeaway. Gold and silver aren't about getting rich fast. They're about preserving purchasing power while the system transitions. Central banks aren't trading breakouts. They're preparing for decades, not quarters. Most professionals suggest modest exposure. Not all in, not zero. Enough to matter if the shift accelerates. Physical ownership matters if the purpose is insurance, not leverage. Final thought. You're not late. You're early to the middle of a very slow, very deliberate repricing of money itself. Central banks are telling you what they believe, not with speeches, but with action. They're buying metal, they're bringing it home, they're building alternatives. That's not a conspiracy, that's policy. The only real question is whether you're watching what they say or what they do.